When we were 16, we actually started something that was fairly interesting. It was a ride-sharing platform for school commutes. And we launched that in Dubai, and it ended up scaling to a couple thousand users. The best excuse to be in California, Silicon Valley was to go to college there. And so we applied to study computer science at Stanford. Both of us were lucky enough to get in. And that was supposed to be the beginning of a pretty exciting journey abroad. But when the pandemic hit, we both found ourselves back in Mumbai, which is when we started experimenting with the grocery space. I mean, the overall round was about 9 million.
Okay.
And then 50 million led by Gladebrook, and then 100 million led by Y-combinator.
Wow.
That was, I believe, July 2021 to December 2021. So crazy period. Because if we're going to become a company of thousands of crores, whether we're a 12-month-old company or a 12-year company, we'll have expectations and compliance. That was the format that we took, right? Let's bring on board senior folks that have clarity, can build teams and already understand what needs to be done so that we can avoid making the mistakes that will almost inevitably happen if we try building it first principles. If we stop growing, stop launching new markets, which we will not do, but if we did that, we would have a clear roadmap to getting to cash flow break even as an overall business within a reasonable time frame. Not 3 years, 5 years, but within a year, maximum year and a half. Once we get there, 5 years from now, I'll be talking to you saying, you know what, we're a highly profitable public company in grocery. What's next, right? But for now, I know what's next. It's first getting to that level.
India never expected, right? So I would put you in the same category as Mark Zuckerberg of India, because he was 19 when he, started building Facebook. Hi, this is Aadit Palicha. Welcome to 100x Entrepreneur Podcast. Today I have with me Aadit Palicha, CEO of Zepto.
Yeah.
Aadit, you have taken the e-commerce and grocery industry by storm. You are the fastest growing company ever in India in e-commerce. Grocery was never imagined to be a 10-minute delivery category.
Yeah.
So thanks to you for creating that category, disrupting that category, right? And just to give, a background to our audience, right? Flipkart was the one who pioneered doorstep delivery of any goods in India. Then Big Basket came and said, we can deliver grocery in X number of days.
Mm.
And I think then you came last year. You said that forget about number of days or hours. We'll deliver you in 10 minutes.
Yeah. No, I mean, it's wonderful to be here. Thank you so much for having me. And, you've obviously, been very generous with the introduction, but I think when you make it sound that way, I think, I should probably use you in my investor pitches. But it's wonderful to be here and, happy to dive into the journey.
So Aadit, go back and understand your background, right? Where you grew up and what you did in your education. And then how did Zepto came out? There were a lot of pivots. So want to dive deep into those pivots?
Sure. No, I'm happy to give you a sense on the background. I mean, to give you a sense, we, both Kevalia and I are originally from Mumbai, but we spent most of our childhoods in Dubai, right? So studied there. Although most of our family was in Bombay, we ended up, being in Dubai growing up. And we spent a couple months a year in Mumbai, to come visit the family. So we're always connected to the city. But, for us, most of our bonding happened pretty early on in life. So I actually met Kevalia when we were about 9 years old. And the two of us had a lot in common, Bombay kids in Dubai, same school. And both our dads were engineers by background, right? And that sort of pushed both of us into a love for building, right? Fortunately. And that's how we started. KV was always a little bit more technical than I was, taught himself how to code at a fairly young age. I used to experiment with multiple different, smaller projects, like everything, basic stuff. Chrome extensions, mobile applications, websites growing up. When we were 16, we actually started something that was fairly interesting. It was a ride-sharing platform for school commutes. And, we launched that in Dubai, and it ended up scaling to a couple thousand users and, quite a few schools in the city. And eventually we had an exit from that startup, which was pretty mind-blowing to us because we never realized that this hobby of ours of, building out interesting technology products could actually be a rewarding career path financially and professionally. And so that's when he took a step back and said, hey, we've grown up, we've been experimenting with different projects, KV and I have been working together on a couple. But, although we're getting the basics of product building and actually figuring out what customers could use on a frequent basis, what we really wanted to understand was how do you build an organization around those products? And how do you build an Amazon or an Airbnb or an Uber or a Flipkart? And we figured the best place in the world to go and learn that would be Silicon Valley in California. And so after setting that first small business, two of us were about 17 years old, we decided the best excuse to be in California, Silicon Valley was to go to college there. And so we applied to study computer science at Stanford. Both of us were lucky enough to get in. And that was supposed to be the beginning of a pretty exciting journey abroad. But When the pandemic hit, we both found ourselves back in Mumbai, which is when we started experimenting with the grocery space. To give you a sense on that journey, I mean, for us, the reason why we got into grocery in the first place, it was a problem that hit us right in the face, right? Firstly, we couldn't stay with our family because they were quite old. We didn't want to expose them. It was COVID at the time. Secondly, we couldn't find a reasonable apartment because we were two bachelors in Bombay in the middle of the pandemic. And so it was a complete no-go
Yeah.
from a landlord perspective. And so we moved into, Kevalia's home in Shere Punjab in Andheri East. And the first thing that we realized as two guys living alone in the first lockdown in Mumbai, it was an absolute nightmare to get groceries, right? All the offline options were shut. The online options were taking 6-7 days to deliver, even in some cases. And that just was very difficult for us to manage. And more importantly, our neighbors around us, our newfound neighbors, had exactly the same problem. And so it started with the idea of delivering from, local options. And Kevalia and I used to go out and deliver ourselves. But then slowly we sort of realized that, hey, although the service that we had, and it was called Kirana Cart initially, where we were delivering to people, locally in neighborhoods, ourselves, right? Although that was slowly growing and we were starting to bring delivery partners on board, making a service out of it, we realized that really, if we wanted to get a significantly better customer experience, we had to innovate on a new model. Because when we spoke to customers, they said, okay, in our early rendition, we were delivering in 45 minutes. We had a pretty small assortment. It was not very reliable, so you might have gotten the wrong items at different times. But when we spoke to customers, they said, look, we're using it because there's no other option. The second this lockdown is over, we're going to go back to something else, right? Because this experience is not great. So we said, okay, fine. We need to build a much better experience so that we can actually hold on to customers post the lockdown. And that's when we started experimenting with the dark store model, right? And we figured that with the dark store model, not only can we streamline our entire process to get deliveries done much faster, which when we looked at the data and spoke to customers was a very exciting value proposition for them, but also we were able to, figure out how to sustainably provide on our platform more assortment and do it with more reliability, because we were able to, design the process with a lot more clarity than if it was just local deliveries that were ad hoc, sort of like a Man Friday model. And so that gave us the ability to launch the first rendition of Zepto. Took us a year of pivots, right? And we tried multiple things. Right? The local delivery one was just one attempt. We did everything from a SaaS-based model to a pick up and shop model. There was all sorts of different pivots. But eventually, when we started experimenting with the dark store model, the first thing that we realized is that customers loved it. We would speak to customers and they say, hey, this is special. Like, we are now going to use you a lot more. And we saw it in the data as well. The retention rates of customers improved significantly. Customer satisfaction scores improved. And we tried to be as methodical as possible with the numbers, right? So that we knew we weren't drinking our own Kool-Aid.
Yeah.
And so, once the numbers told the stories that they did, and the customers around us, the local customers that we were delivering to, said, hey, this is something that we'd really be excited about. That's when we got the clarity to say, okay, we need to double down on this dark store model. Let's rebuild the company in a new light. Let's call it Zepto and let's get started, right? And so that was the journey from, Dubai to, dropping out of Stanford, coming to Mumbai and starting this company.
When did you get this insight that you want to drop out of Stanford to relocate back to Mumbai?
It was the pandemic, right? And we were anyway not able to go to college at that point. And so we had to come back effectively home.
But you could stay
So-
there, right?
Not really. I mean, a lot of international kids ended up coming back because it was very uncertain, right? So most people ended up coming back doing classes online. And so we said, firstly, online classes were terrible, right? And so we decided to avoid that, took a year off. And you're able to take a year off at Stanford and say, okay, I'll rejoin next year. Right? And that was the idea initially. So we tried the online class test. It was terrible. Said, let's just do it a year later. It'll be a much better experience. And in the meantime, let's see what we can do. Can we solve some problem statement? Can we learn something ourselves? And so that was the idea. It was not very well thought out. Keval and I didn't have a great internship lined up at Goldman Sachs or JP Morgan like some of our more responsible friends. We just said, hey, let's take a year off and figure out an interesting problem statement. And over the course of the year, we started getting obsessed with grocery, right? And by the end of that year, mid 2020 to mid 2021, that's when Zepto was really born. And we started seeing a lot of scale and a lot of quick growth. And then when the clock rolled around and said, hey, it's time for you to re-enroll at Stanford, we had a data, a solid product, and a fast-growing business. And it was a lot easier to take that decision when you had something really concrete behind you. And so, yeah, in mid 2021 is when we had to take the final decision on whether to enroll or not enroll at Stanford. And we took the decision, obviously, not to enroll. So, yeah.
Hi everyone. Before we begin, I would like to share that this podcast is brought to you by Prime Venture Partners, an early stage VC fund led by Amit Somani, Shripati Acharya, and Sanjay Swami. Prime is often the first institutional investor in category defining tech startups in fintech, SaaS, healthcare, and education, such as MyGate, Quizzes, Planet Spark, Bolt, and Clip. To know more about Prime, visit primevp.in.
And when did a Y Combinator and Nexus happen for you?
So, we had been in touch with Nexus for quite some time. They actually reached out to us very early on as we were going through the journey of pivoting from the early versions of our business to eventually Zepto. And, they were in touch with us. They were, constantly helping us brainstorm. I actually got, a ping very early on in late 2020 from Arjun, who was a, associate on the team, saying, hey, we heard some interesting things about you. And he kept in touch with us, kept brainstorming, picking on how we were actually thinking about building this business. And then once they saw that clarity and they saw that conviction on the product market fit of the model that we were building, they came in and said, yeah, this is interesting. This is something that we think makes sense. So they came in, I believe we started drawing something up around March of 2021. And by July, August, things wrapped up. We had money in the bank from Nexus. After that, there was just a crazy journey, right? We started growing 150% month on month, which is not for the faint-hearted, right? It was definitely quite an experience. But more importantly, that growth helped us obviously attract investors, right? We're talking about mid to late 2021. And we had, a couple of folks that we were talking to, but Y Combinator continuity reached out. We were in touch with YC because even in the early days, we were a Y Combinator startup, right? So we were part of the early stage batch. And so they were constantly in touch with us and said, hey, you guys are growing really fast and you're now getting to millions of dollars in sales. Why don't you talk to the growth folks at YC, right? Later stage guys. And so we spoke to them. They were very excited about the thesis. We found them to be incredibly thoughtful and high quality investors. And so we ended up just, taking a term sheet from them. And that was actually our Series C. So Series A was Nexus. We did a Series B with Gladebrook Capital, which was, I think, about a month and a half after Nexus. And then a month and a half after Gladebrook, we did YC. So it was like a good 3-month period where we raised 3 rounds.
So first check was 2 million from Nexus?
No, it was more. The overall round was about 9 million.
Okay.
And then 50 million led by Gladebrook, and then 100 million led by Y Combinator. Wow. That was, I believe, July 2021 to December 2021. So crazy period. But yeah.
Wow. And how has been the growth in the company, right? What are the challenges that you faced in growing the company?
So look, we went from 0 rupees in sales to thousands of crores of annual sales in the span of 16, 17 months.
Yeah.
So it was a lot, right, to answer your question. But look, the challenges in growing, I think, our thesis on Blitz, on scaling this fast, right, was, we are in a market that everybody's interested in because we're building out what I feel is the best product in the largest market in the country, right? This product format of delivering incredibly quickly has had much stickier customers and a lot more excitement among customers than any other online grocery product that's come before that. And grocery in general in the online world has been the biggest unopened question or unsolved question for e-commerce for, over a decade now. And so we came in saying there's going to be a lot of interest in this space from a lot of the larger players. We need to scale so that we can get a foot in the door very quickly. And so when that became apparent, we realized a couple of things. First, this is a very complex supply chain business, right? And although Kevalia and I, through with First Principles, we were trying to pick up supply chain theory ourselves, we realized that, look, we can bring on board strong expertise that understands this and has got, a decade plus of experience, in businesses of this type to come in and help us accelerate the learning curve. Because if we're going to scale quickly, we have to learn faster. And more importantly, we can't make mistakes, because if we make a mistake today and we're going to be 150x in 12 months, then that problem is going to be 150x bigger. And so bringing on board someone that had that clarity and did not need to go through the same learning journey that Kevalia and I had to go was imperative, right? And so we brought on board the best supply chain folks. We also brought on board the best marketing folks that we could find and the best, business and category folks that we could find. And that really sped things up, right? So that was number one. And number two is, once the team was set on blitz scaling, I think the leadership team could take a step back to make sure that, okay, we have senior folks, they built a team around them. We're able to start scaling very quickly. Now, because there's a team that's being built underneath and is constantly being built, the leadership team can take a step back and focus on all the pieces that are not related to scaling. So the biggest challenge with growing this fast in a business as complex as ours is that you can blow up, right? If you're not prudent, if you're not careful, things can go out of hand. And so we took a step back and said, okay, the scaling process is underway. Let's focus on everything that's not related to growth. Let's focus on building the right systems so we can optimize our unit economics, right? Let's focus on building the right controls internally so that we don't have any serious issues going down the road. Let's focus on compliance, right? Because if we're going to become a company of thousands of crores, whether we're a 12-month-old company or a 12-year company, we'll have expectations and compliance. And so that was the format that we took, right? Let's bring on board senior folks that have clarity, can build teams and already understand what needs to be done so that we can avoid making the mistakes that will almost inevitably happen if we try building it first principles. And once that senior team was in place, we were able to build a team underneath them because they obviously had clarity on what team needed to be built. And that team was able to start blitzscaling. And then as a leadership team collectively, we could take a step back and focus on all the controls and guardrails around the scale that we needed to build, everything from the right unit economics processes to the right controls and compliance that we needed internally, so that we could actually build a company that was not just going to go, absolutely crazy. And frankly speaking, that is probably the only reason why we were able to raise, $200 million later in May of 2022, when the Nasdaq was losing a few hundred points a day. It's only because investors were, seeing, surprisingly, despite the very heavy investments in growth, they were seeing some pretty solid trends on unit economics emerging quite quickly, and mature dark stores, trying to hit that profitability point. And also they saw maturity in the processes and the controls that we built internally, right? The reason why we were able to do rounds back to back with, pretty esteemed investors is because our diligence was sorted. We had a good cadence with the right folks. EY did our financial due diligence for the round that we raised mid-2022. And so that put us just in good stead, where even though there was a lot of headwinds in the market in May of 2022, you still pick up $200 million in cash, right? In a world where people were losing term sheets, rounds are not getting closed.
And right now, how is the business growing month on month? At what rate?
If you'll forgive me, I'll refrain from absolute numbers. Sure. But we are currently on a year-on-year basis, we're not growing in percentage points, we're growing in multiples, right? And so we're feeling pretty good. We're multiplying year on year. I think currently this industry is definitely the fastest growing consumer internet industry in the country right now, and we're benefiting from that. So yeah, I think unlike most consumer internet companies, from edtech to fintech to food delivery, e-commerce, ride sharing, cryptocurrencies, everything, most of them have started flatlining in an environment like this. We are growing pretty healthily, and we're expecting to multiply significantly by the end of this year, given where the growth rate is right now.
Do you think there's an upper market cap in this ceiling, like you're already touching $1 billion in valuation?
Yeah, it's a good question. Look, I think grocery is massive, right? And I tell people this all the time, that DMart, phenomenal company, was started before I was born, right? Obviously different business model, different thought process, but if I look at the fundamentals, we both are trying to do different things in the grocery space, right? And we have a lot of admiration for a company like DMart. They were started before I was born, right? May of 2002. In 20-21 years, they've built a $30 to $35 billion business, fluctuates, but around that, right? And they are, less than 10x our size in sales, and we are growing multiples every year, right? And so we are living in a world where we can conceivably be, in a handful of years, the same size as DMart, hopefully. And if we do that, we're sitting on a business that's $30-35 billion, has the potential to be worth $30 to $35 billion, right? And so right now, when I look at the ceiling, I think we barely begun. If anyone can build the largest business in internet in the country, it'll be online grocery. 75% of all, consumer white goods spending in this country happens in grocery. So this is the category to build a large business. That's the biggest advantage we have, right? It's a tough business. It requires a lot of discipline, a lot of rigor. It's low margin, no doubt about that. But if you crack it, you're sitting on the potential to build, one of the largest companies in the country. And so, yeah, that's the way I look at it. DMart, 21 years old, just, couple of years away from their scale right now. And that's a $30 billion company.
Got it. And right now, the pace you are scaling it. So I see that within 3-4 years, you should be closer to the sales number 30-35.
No, they're worth 30-35 billion, but they're only...
Like net revenue would be like around 3 billion, I believe.
Yeah. I mean, you'll know the numbers offhand. Yeah. That's what we're hoping for, right? I mean, I'm saying that there's a realistic world if we execute well, where we can get there. Obviously, if we don't execute well, we can't, right? But I'm quite hopeful that that's where we can get. And that's the ambition of the team. It's definitely possible. Whether we're able to, whether we will do it or someone else will do it, time will tell. But I can tell you for sure it's possible in a business and a market like us.
And by that scale, you will be the largest internet company in India.
That's the ambition. I'm sure the other large companies in India, by the time we get there, might have grown also. But it's the ambition, right? Hopefully we can. I'm sure every entrepreneur that you've spoken to in this space has the same ambition that I do. So I don't think I'm probably unique there. But I feel like we're in a space that can do it. We're talking about grocery, right? So it is the space that where you can build large businesses out of.
Dear listeners, if you have been following our podcast, you would have been hearing about Zoho Payroll. Zoho Payroll's mission is to democratize payroll technology for everyone. Hence, they have made a free version of Zoho Payroll for startups and businesses who have up to 10 employees. It has all the features to automate payroll compliance, salary calculations, payments, and much more to pay salaries on time. You can use it for free forever, no questions asked. Even as a startup, give your employees a great payroll experience right from the start. Check out the link in the description to know more about Zoho Payroll. Thank you.
I think one differentiator can be, can you reach there profitably?
Yep.
And is that even possible? Because no internet business in India that has even gone public, right, in the last year.
Yeah.
Nobody's profitable.
Yeah, it's a very fair question. Look, I think for us, you find something interesting. Most of the Indian ecosystem for startups was built between 2011, 2012 and 2021. That 9-10 year period. And in that period, American interest rates were effectively 0%.
Yeah.
And capital was essentially free, right? And so there was this huge amount of cash flowing into the country, right? I mean, we saw it, the amount of unicorns that were created, especially in the last, from 2020 to 2021, it was just mind-blowing, right? Huge amount of inflow. And what that abnormally long bull market cycle has done, frankly, in my mind, is created a lot of companies that lack fiscal discipline because capital was free, right? We are one of the only companies in the country right now at our valuation scale that has been built predominantly in a bear market, right? Most companies have spent 4-5 years in a bull market and only this year in a bear market, or the previous year, 2022. And so we've actually spent most of our life cycle in a bear market. And that's given us a bit of a different DNA, right? I think we've got a lot more maturity of processes and governance than most companies do at this stage. I think we're in a position where if you look at our unit economics, you'll be quite surprised. And that's one thing that I continue to bank on. And, frankly, for me, looking at where we are right now, we're sitting in a world where our mature dark stores are fully loaded, turning fully loaded cash flow positive without exaggeration. And I know there's a lot of, creativity in what's above and below, those numbers, can I remove my replenishment costs? Can I put customer support costs in corporate? You can do all that Excel jugaad. But today we're in a position where fully loaded, looking at all the line items we have, we're actually turning dark stores, fully profitable and not, in the future, 9-12 months, not like this quarter, right? And while that's happening, we're also realizing that that's happening faster than supermarkets turn profitable in India. If you look at Nielsen's data, the average time it takes for a D-Mart, Reliance Fresh, More Retail, Spencer's Retail, etc., all companies that we have a lot of respect for, it takes them 18 to 24 months to turn a new supermarket profitable. We're doing that sooner than 18 months. And that's our first batch. We expect that timeline to get shorter and shorter in the future as our playbooks get tighter and tighter. And so sitting in a world where we are one of the fastest growing consumer internet companies in the country, we are, turning our dark stores profitable faster than supermarkets. Sure, it's a different business. We have a different model. It's a, different way of generating, revenue and sales. But yeah, fundamentally, I'm looking at the signs as a very early company. I could not be more bullish on where the long-term prospects of profitability lie. And to me, if I see stores generating cash, right, that to me is just a function of, okay, I now need to get all my young stores to that same level and I'll be golden, right? And so it's obviously a function of how much we want to grow as well, right? If we keep investing in new markets, there will always obviously be an investment cost to that. So I don't want to leave you with the impression that we are, 9-12 months away from getting to fully loaded business profitability. But if I be honest with you, if we stop growing, stop launching new markets, which we will not do, but if we did that, we would have a clear roadmap to getting to cash flow break even as an overall business, within a reasonable time frame, not 3 years, 5 years, but within a year, maximum year and a half. So yeah, I feel fairly good about that.
And how many cities you are in right now?
Every major city in the country: Mumbai, Bangalore, Delhi, Hyderabad, Chennai, Pune, Kolkata, Noida, Gurgaon, Ghaziabad. Then we're scoping out a couple more.
And you would have touched 1,000 dark store number.
No, we don't have 1,000 dark stores, but we've got a few hundred right now.
God, India never expected, right? So I would put you in the same category as Mark Zuckerberg of India, because he was 19 when he, started building Facebook. And it is a different domain, right? America's internet first company. India is a very hardcore infra
Sure.
company.
Yeah, absolutely.
That country, like the new age entrepreneurs are creating bits, and
We're
their
creating
entrepreneurs are
atoms.
creating atoms.
Yeah, no, I think it's a very flattering comparison. I think we've got an extremely long way to go before we're even in the same zip code in my mind. To be honest with you, I don't operate with the mentality that we've succeeded. I think that's both Kevalia and I wake up every morning knowing that if we make the right decisions, we're sitting on that DMart level outcome of building a $30-40 billion company. And if we make the wrong decisions, we won't build a valuable or meaningful company. And so I don't think we're there yet where we can really be in a position where we are compared to serious levels of success like Mark Zuckerberg. Long way to go for us for sure. And hopefully, in a couple of years, we might feel better. But until I can tell you in good faith that we've built an enduring institution that's created value for shareholders that's sustainable, until that point, I will just remain with the mentality that we have a long way to go. So, yeah.
So I assume, right, not everything would be a tailwind in your business.
Yeah, sure, absolutely.
What are the headwinds? What are the challenges that you're facing on a daily basis?
Yeah, there are tons of headwinds, right? No doubt about it. So when I look at the fundamentals, I honestly might be surprised, but I don't see as many headwinds as our friends in the media would like people to believe. But some of the key headwinds, I think, my thought process right now is how do we, off the bat, obviously, there is a dearth of capital available for any high growth consumer internet company. And so that doesn't affect our ability to sustain and run day to day, but it does mean we have to be more conservative with our plans. Right? Today, when I look at our business right now, and I look at the potential to grow and not just grow, but also drive scale economics that will improve our overall P&L, right? But more scale for us also gives us better utilization of fixed costs and the assets that we have. And it also helps us drive better variable costs with higher throughputs, right? So I see a lot of potential to grow more, to drive better operating leverage from our fixed costs. But obviously that we can't do that, right? We have to be conservative in a market like this. So I think that's the biggest challenge, where there are lots of opportunities for us that I would like to realize today. But I suppose we'll have to wait for a while to be able to realize that, which is fine. That's life in the big city. But definitely, I think, for us, as things stand right now, we're operating in the model where, we're going to be fine in this downturn. But hopefully things continue to go well. But we could do a huge amount more. There's a lot more potential that we are waiting to unlock. And so, when capital becomes available, it'll be great to unlock that value. But frankly speaking, for the next couple of months, I don't see the need or the requirement to raise capital, especially in a situation where we will just be pushed back irrationally, right? So the good news is that we've derived enough operating leverage that we don't really need capital. But could we use capital to grow? Absolutely. Will we raise capital at some point? Yes. Should it be today? Do we need it today? Not really. So let's wait a couple of months or maybe even longer than that. So yeah, that's currently my thought process and the biggest headwind. That's not just facing our business, but I'm sure it's facing a lot of good internet companies in India.
And it's a fair point, right? And when in US, and US is the largest market for capital, a large investor could get a public company at 400, 500 million valuation. The entire company was just doing a 200 mil revenue. So where does the new capital come from?
Yeah, it's a good question. Right now the answer to the where does the new capital come from is it comes from our business. Like we have to just be more efficient and save more money, drive better operating leverage, and take the capital that we've saved and then invest it back into the business. So right now, in this market, the best source of capital is the capital that you're able to drive from the mechanics of your business. And I think we've done a reasonable job of that so far. But can we be better? We absolutely. And will we improve? No doubt about it in my mind, quarter on quarter.
I think the first very large milestone for you could be hitting the first 100 mil ARR on the net revenue in the business. Not the GMV, but the net revenue in the business.
I think we crossed that milestone a while ago. That was a while ago, but I think obviously that doesn't mean that net revenue is generating cash for us in the bottom line. But I think we're in that territory, have been for some time.
Got it. And do you see how DMart went public really early on? Because see, I have a fundamental belief that startups in India shouldn't go public at $10 billion valuation.
Oh.
Because retail investors don't buy that story.
Oh.
DMart went public really early on. It made retail investors a ton of money. What is happening was, especially last year, and I being a VC myself, no offense against other VCs, but VCs were trying to capture the maximum value in a company. So companies got listed at $20 billion valuation, $10 billion valuation. And you being an Indian company, a listing is, of course, right? It's not an exit strategy, but it's a check mark. It's a next phase, right, of maturity in the company. So I think a company in India can't go public at $10 billion in valuation.
Look, I agree. I think for some reason, in my mind, we treat technology companies differently from legacy companies in India, right? And there is this subconscious disdain for the old Indian flag bearers. They are too traditional. They were not, progressive enough. The reality is that a lot of them did well, right? And they built businesses with the right principles, right? Like, today we're sitting opposite the Larsen Turbo office, right? Which is, in my mind, one of the best managed companies in their space, not just in India, but in the world for the space that they operate in, right? And then you've got folks like DMart, right? That not only build a business with the right principles, but decided that, value accretion can happen in public markets, and why can't retail shareholders, share in that value, right? And so for me, I don't know why you can't build a technology company with the same principles. Obviously, capital, operating with a high growth mentality, being venture backed, no issues with that at all. But fundamentally, the principles are the same, whether you're a bootstrap company, a venture backed company, or something in between. And so for me, I look at our business. If we are lucky enough to build a business that has got the quality to go public, which I think we are doing. But if we do, I would try my best to do it in a way where we can accrue value as a public company, right? Why as a private company? So that's my thought process.
So what I was just trying to say is that DMart also went public around 3 billion kind of a valuation, where it made today 10x for the retail investors. So
and I don't see why Zepto and other internet companies can't do the same. I agree with you. Like, you don't have to go public at the end.
At 30 billion valuation.
You don't need to do that. I mean, each to his own, right? Obviously, I can't comment on how other folks have decided their exit strategies. Maybe for some companies, 20 billion is the beginning and they're going to go to 200 billion, right? Who knows? But I mean, what I can comment on is on my end, I agree with your thought process. Like, why wait until we are at a very large scale to go public and then have that constant fight with retail shareholders? Let's build a business that can accrue value publicly. Why not?
And if we see from a point of view of institution, right? Today, Hindustan Unilever is valued at 70 billion. Titan would be valued somewhere in that range, 60 to 70 billion. And they would be doing like $6 to $7 billion of revenue each. And as these groups started to scale, they built different set of companies, right? Tata has like 30, 40 different public companies as of today. So I think like a same path for Zepto in future, where if you are building like one institution in one category.
That's definitely the objective. No entrepreneur would say no to that. It's a hard journey. I think right now, frankly, it's not even a 5-year journey. It's a 30-year journey, 40-year journey. So it's definitely something that any entrepreneur would want to do in the company they're building. Hopefully we can do it in ours as well. But I think in the next 5-10 years, building Act 1 of the company, which is a high quality online grocery company that's really disrupting the way people buy the most bought item in India, which is groceries, right? That I think is an exciting enough story in itself. But absolutely, building an institution beyond that, once we get there, 5 years from now, I'll be talking to you saying, you know what, we're a highly profitable public company in grocery. What's next, right? But for now, I know what's next. It's first getting to that level.
But does it really feel proud that among your peers who are doing jobs, you have built $1 billion business at 21 and 22 years of age?
Yeah, I also wish I was 21, 22. I'm not there yet. I'm getting
so 20, close. Right?
20, yeah. I mean, I don't really dwell on that. Each to their own journeys. I think for me, I'll be able to tell you with a lot more confidence that, hey, we really made it once we have that enduring company. And the good news in my mind, what gets me excited is that I think we're moving in the right direction there. So long way to go, but we're definitely moving in the right direction. Will we get there? I'm very confident that we will. But until then, I can't tell you with good faith that, hey, we are smashing successes. Like, there's a long way for us to go. We're doing it. I think we'll get there.
Red is your favorite color, right? I've always seen you in red.
It's cherry pink. Zepto, the Z in Zepto, it's cherry pink. That's my favorite color. I can't wear a cherry pink t-shirt, but I would like to.
Got it. And what's besides, Zepto that's keep you occupied? Where do you learn from besides the business?
Look, the honest answer is 99% of my learning comes from the business, right? And it comes from, what I've been lucky to do is surround myself with some very solid leaders that are much more intelligent than I am. And learning from the leaders that we have internally and learning from the investors that we have externally, that's where 19% plus of my learning comes from. And then also the rest of the ecosystem, right? Founders and entrepreneurs and investors that have been part of some really sustainable value creation journeys. And I try to surround myself with those folks, not the folks that haven't done that. Right? I think the mentality that I'm trying to instill in myself and instill in other folks is one of building a really high quality company that's well managed.
And what's the milestone for you for 2023 that you want to achieve?
Yeah, I mean, we're hoping we can hit $1 billion in annualized sales by Q3, Q4, 2023. It's going to be tough, but if we can do it, nothing like it.
And right now, what's the priority that you see from the market point of view? What are your investors telling you? Profitability is the key to...
Yeah, absolutely. I mean, profitability is the key. I think, honestly, we don't operate in a manner where investors have to tell us that. I think we've been doing that, even, believe it or not, even before the whole world, the capital markets became tough. We were talking about that. I'll give ourselves credit that even in 2021, we built, very deep dashboards on unit economics and built pathways to improving it. And that paid dividends coming 2022 and now in 2023, where our base was quite solid. So our investors are talking about profitability, but we're also talking about profitability. So it's about mixture of profitability and growth. I think the way that I look at it is growth and profitability are not at odds with each other. If you want to really build a good company like DMart, you have to be generating thousands of crores of free cash flow and doing it while growing at DMart scale 30-40% year on year, which is great. So yeah, that's the way that I look at it. Right? They have built, and not just them, but like most high quality companies grow and are profitable at the same time. So why can't we do the same thing?
And for you personally, right, you would have changed a lot since starting.
Sure.
So what are the changes that you feel in yourself as a person?
I've had to become a lot more mature. Right? I've had to behave a lot more like a 45-year-old than a 20-year-old. And that's cool. I think it's great, obviously, that accelerating learning curve over the past year and a half. I think I've got 20 years of work X in 1 year, if I had to be very frank with you. So that's the biggest change. Just the huge evolution that I've had to do personally and as a leader. Yeah, it's been crazy. I mean, it's just made me a better founder.
Did you anytime during the business face anything from internally or externally that, hey, I have more gray hairs, so let my decision overrule than a 20-year-old's decision?
So not really. I mean, I think both the investors we have and the leadership team we have, everybody's very merit oriented, right? I think that's the one thing that you'll find about our culture is that we're very objective. We have a lot of attention to detail and we are obsessed with meritocracy, right? And so it is never, hey, my idea is better than yours because I've got 2 decades of work experience, or my idea is better than yours because I'm a very senior investor, right? It's always a very objective, lash out of perspectives. We debate it, and whoever's is objectively going in the right direction for the company, that's what we end up going for. And so I think what I really respect about my leadership team is that they've had the maturity to put aside, let's say, an age difference. Maybe some of them are twice my age, right? More than twice my age. And so they've had the maturity to put aside age differences and really just focus on substance and say that what's the substance of what we're discussing? And hey, a lot of the times Aadit is right and a lot of the times I'm right. And we have a good relationship that way. So yeah, we've tried to keep it objective, rational and merit oriented, and that makes the decisions a lot more productive. I think once you start getting into I'm X and you're Y, discussion is defeated.
And historically, we have seen when a company scales that fast, like you grew 150x in a year.
Sure.
All right. Culture is the first thing that takes a hit. How did you avoid that?
It's a great question. I think it's a work in progress. Our business by nature requires certain qualities to be successful, right? Attention to detail, rigor, governance, discipline, intensity also to go through that, right? So I think everything that the business is required and to get to this level in the first place culturally is ingrained in our company. Like if you come into our company, I think, we've got some of the hardest working folks in corporate India in my mind, genuinely. And I don't say that as like a loose comment. I frankly believe you would be hard pressed to find a company with, people that are as hardworking as the folks that we have, right? And so I truly grateful for that. That value has been embedded. I think there are other values, attention to detail and rigor and discipline that's come because we know the kind of business that we're building. And we've been clear about it since day one, that we're not building like a 70% gross margin SaaS company. We're building something that's going to be a lot more challenging and nuanced, but can be a lot bigger, right? With that in mind, these guys have got those qualities embedded. I think for us, we're working on the other values as well that are important to us. But some of the core values have been instilled just purely as a function of what's been needed, what people have been pushed on. And also because we've taken our time to really hire. And although we grew fast, we never compromised on the quality of folks we brought on board. So yeah, we never put ourselves in a position where we hired someone because it was easy and convenient and we needed someone in the short term. And even if that person was not worth it or did not meet our standards. And so that was painful in the short term. A lot of issues were created as a result of that. But today, we're better off as a result of it. But can I tell you that we're done in our culture building process? Absolutely not. A lot but it's definitely a WIP.
And how big is the team right now?
It's about 1,300 folks.
Wow. And
Yeah.
it must have been a crazy journey for you, right? Taking so many interviews
Yeah,
in a span of a year.
I still take 1 to 2 interviews a day,
And,
probably even today.
and at its peak, it would have been like 5 to 6 interviews a day.
I mean, at the beginning of Zepto, I had interviews starting at 8:30 a.m. and ending at 11:30 p.m., 1 a.m. When we first interviewed my current chief marketing officer, I spoke to him at, I think, midnight on Saturday, 12 to 1, something like that, or 11 to 12 or 12 to 1, but it went on way beyond midnight. So those are the early days. Now, obviously, a lot more to do than just hire. But yeah, absolutely. I've had days with, without exaggeration, 13, 14 hours of interviews minimum.
And where this ambition come from, right? To build a very large institution, because I see you don't come from a very large business family,
Yeah.
right? And at Stanford, you would have seen many multiples of businesses getting built, right? So you could have chosen to stay there. But right now you are building, and you pivoted many times during your initial journey.
Yeah, I mean, I think honestly speaking, the idea was never to build a business. We're just in love with this product. And when we realized how big this product could be, we felt that, to do this product justice, something that both Kevala and I believe in personally and we're very excited about, we had to take it to the big leagues. And that means building a big business. But if you zoom in, fundamentally, what's the ambition in doing this? I love this product so much. I use it probably twice a day, or on Zepto, probably, like, without exaggeration, twice a day. And yeah, I mean, it's something that I feel as many people as possible should experience, because it's really a game changer. And in that ambition of bringing it to as many people as I can, I have to build a good business.
Thank you so much, Aadit. Loved hosting you on the podcast.
Wonderful being here. And again, it's good to have conversations that are, oriented towards, value creation in a meaningful way. So thanks a ton.